All right, so I wanted to present this problem that I thought was a nice, sort of well-rounded piece of all the topics and receivables we've touched on. Um, so basically, I give you a starting balance for accounts receivable and our allowance for credit loss. I give you some transactions that happened during the accounting period, which for this company is a single month. They close the books at the end of every month. They use the gross method for accounting for cash discounts. So you have these transactions to record. You have an aging schedule, and so the first just asks us to record some of these entries. Now, I'm going to go kind of fast through these because you've seen them before, and some of them are a little repetitious. With the 1-4 entry, we recorded a credit sale. I don't give you the COGS information here. If I don't give it to you, then don't worry about recording COGS. If it's there, then record COGS. But right now I'm focusing really on the accounts receivable piece. When we make this credit sale, we can debit, of course, our accounts receivable and our sales revenue. And because we're using the gross method, noting the effects there, I want to record the full amount, 937,000. So remember, whenever we're working under the gross method, gross meaning full, we assume that customers are not taking the discount. Therefore, we record it at the full amount, right? We're not seriously assuming that, but that's basically what our entry says. Now, the write-off, a $20,000 customer account for Alpha, I just give it a name because now the way I like to describe these entries where we debit ACL and credit our accounts receivable. And specifically, we found that Alpha was the customer in question who could not pay. And as I said, I mentioned them individually because what this really is doing is reducing our estimate and making it a reality. So how is it an estimate into a reality? Well, remember, allowance for credit loss is just our running estimate of what we think we are going to have in dollar value of customers who cannot pay. So if this is the ACL account, it started at 52,100 and it was matched off against $485,000 of receivables. Remember, that just means of these 485,000, we believe 52,100 will default. Well, we found a $20,000 default. So we reduce our estimate because it's no longer an estimate. It actually happened. And to make it a reality, we credit the specific account of the specific customer that has defaulted. Remember, this has no customers attached to it. We don't know who's going to be a bad debt until they notify us and we write them off. Okay. ACL is a contra asset, but even though it's a contra asset, it still moves the way of an asset. So it increases ACL, it increases assets to reduce ACL. And a credit to accounts receivable, of course, is a reduction to assets. So we collected some cash from customer accounts from a prior period. So we made these sales in the prior period, did not collect cash back then. Maybe this was in December. They paid outside the 3% discount terms that they were offered. So this is cash that came in at full price. And if we're using the gross method, there's no need for us to make any adjustment for the forfeiture of discount because remember, the gross method assumes that our customers are not going to pay within discount. So essentially, that assumption was correct. Another way to think of it is I got $388,000 of cash. Well, that's full price cash because they paid outside the discount. So if that's full price, does it match the does that match the valuation of my receivables? Well, I'm recording my receivables at full price as well because we're under the gross method. And so the full price cash should pay down dollar for dollar the accounts receivable accounts. So let's think about this transaction, but just as a side, the problem doesn't even ask of this, but just as a sort of teaching moment, a learning moment, let's think about this. This is the gross method entry because that's what the problem told us to assume. But let's just take it over and think of it as maybe a net method entry. How would I record this if it's $388,000 of cash and the customer's paid outside the 3% discount terms? Well, again, I can just start recording the cash because I received cash, $388,000, right? The same here. Now, the difference will be when I record a credit to my accounts receivable, if I'm working under the net method, what value am I inputting to my accounts receivable? That means, is it gross, full price, or is it net of discount? And remember, if we're under the net method, then we're going to record our accounts receivable and our sales revenue net of discount. So if this is 100%, this full price cash, right? Full price being 100%, then what would the receivables be net of discount? Well, in this case, they're net of a 3% discount. So the receivables should be valued at 97% of that full price. So that's $376,360 of receivables that would be credited by this inflow of cash. And then we need an additional credit here because sales discounts have been forfeited. And that comes out to 11,640. Sales discounts forfeited. Now, the reason why I like to do the cash and the account receivable first is because I record the cash, I evaluate, are my receivables full or net of discount priced, and see if that matches cash. If it doesn't, then I have to write, in this case, the net of discount price at 97%. Then this entry tells me exactly what happened. Well, why did I get more cash than the receivables I credited? The reason is those receivables forfeited their discount, so they paid you some extra cash. Remember, the sales discounts forfeited account, it's just a revenue account. It's not a contra or adjunct account for sales revenue. It's just its own net income account. And really another name for it, as I mentioned in the notes, is interest revenue. So that emphasizes where it lands on the income statement, which is in non-operating income. So just a small departure, but it's a good moment to just compare those things side by side and see how they are different and how they are similar. Similar in the cash, different in, well, if our cash is at full price, but our receivables are at 98%, then we have to do some explanation with a third account. All right, let's move on to the next piece. We reinstated an account. The customer had already paid its account, or sorry, we reinstated account and the customer paid its account on this date as well. So we got a reinstatement and a payment on the same day. This wasn't a customer account we wrote off in 20X4. So that is the, basically, we just need to undo the write-off for reinstatement. And that's how I encourage you to think of it. It's pretty straightforward. If we undo the write-off, instead of crediting accounts receivable, we're going to debit accounts receivable. And instead of debiting ACL, we're going to credit it. And then the customer paid their account off. So when they pay their account, of course, we receive cash and we credit that account so that it's now zero. You can combine these two entries. That's fine because you ultimately, if you reinstate and collect, you're going to debit and credit accounts receivable by the same amount. And so it just collapses into a debit to cash and a credit to ACL. That's fine. Either way is fine. Credit sales recorded 830,000 on those terms. I'm going to just blow through this one. You've already seen it. It's gross method. We record the full price. Not even going to bother with the effects. We've seen that. Um, Wrote off another customer account. And again, this one I do just want to just remember the narrative. If I wrote off a customer account, I'm able to identify them. Then I definitely, most definitely, sorry, I was messing up my dating here. Is bothering me. So, all right, 115. Oh, we did miss one. I did miss one. 118 collected the credit sales made on 1/4. All right, so we collected from credit sales recorded 937 million, 3% off if they pay in 15 days. Did they pay in 15 days? They did. So we record all those accounts coming back in cash, but they paid cash within the discount. So instead of 937,000, I just have to take the net of discount amount for my cash, and that comes to 908,890. And this is collecting from receivables that had a total value of 937,000, their full price. Full price receivables, right? Net of discount cash. The reason why we collected less cash than receivables that we zeroed out is because some of them, or not some of them, but all of them, got a sales discount. And that's for the missing 3%, which comes out to 28,110. So remember, the sales discount account is a contra revenue account. And of course, cash is an asset, accounts receivable is an asset. That contra revenue is subtracted directly from sales revenue on the income statement. So very different placement on the income statement for sales discounts forfeited and sales discounts, how they're presented or worked into the value there. On 121 now, we had another write-off. We've seen this, but I will explain it a little bit. Remember, when we have a write-off, we're taking what was an estimate and making it reality. So we reduce the account where we hold the estimate. It was for 19,000. And we make it a reality by crediting that specific customer account. On the 24th, I collected 70% of the accounts from credit sales made on 115. So I didn't make a full collection, and that's all right. They still get a discount for whatever they pay. That was on 115. Well, I only took 70% of that, of those accounts, which gives me 1,281,000. So these are the accounts receivable that I collected from. They paid within the discount. So this is their full price because this was a full price. This was not net of discount. So this is not net of discount. It's just a portion of them. So I would credit accounts receivable for that portion. The cash I would receive, that's 100%, is net of the discount because they paid within the window. The discount was 2% this time. So the cash we collect is 98%. So that comes to 1,255,380. The discount is just the difference. It's the reason why I collected less cash than receivables that I'm crediting. It's 25,620. And again, that's a contra revenue account. And the the final entry before the factoring on 127, I recorded credit sales of 840,000 on terms 315 and 40 right here. That's just a gross method sales revenue accounts receivable entry, and we can record it at full price. Forget what that was. The full price was 840. All right. So I'll stop this here and we'll pick it up again in the next video where we will talk about the factoring entry and then the adjusting entry.